Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Hi everyone, and welcome to another episode of the Brokers Lounge, where this week we're going to be talking everything to do with serviceability of loans, what you need to be obviously mindful of, what lenders take into consideration when assessing your loan application, and ultimately how you can set yourself up to get the best possible outcome for your loan application as well. And we're also going to discuss some live scenarios as well, where we can talk about how servicing is affected by various factors as well. But obviously, before we get into it, Eddie, good to see you again, mate.
Always good to see you, Carlo.
And how's the week been?
Yeah, it's been a good week. A good week. We're starting to see a bit of shift in the market. A lot of more people, I don't know if it's the spring or just people want to actually buy properties. So yeah, we've seen a shift in the last week or so. So we'll see how that continues. What about your week? How you been?
Yeah, pretty much the same. It's been a very busy week. Like you said, we've seen a massive shift in terms of activity, which is great. Obviously, the warmer weather, everyone seems to come out and about and wanting to do things, which is great news. So, but yeah, another week ticked off, and we're getting very close to Christmas. So it's all happening. So yeah, I guess before we get into it, Eddie, probably a good way to start off would be just talking about, when we talk about serviceability, what are we actually referring to?
Yeah, absolutely. And it's a very, very, very important topic in the lending space. And I think it's an important podcast, this one, because you don't get much insight onto serviceability out there. There isn't much information. So serviceability is basically the borrower's ability to make loan repayments on the loan they're applying for. And the bank highly relies on serviceability to confirm if the borrower can actually afford the loan being applied for, or they can't. So, and to be able to confirm that, they have to go through many steps, and they have to calculate it based on the income, liabilities, expenses, and bits and pieces, which we're going to break down in this podcast. So let's get into it.
Yeah, and it's interesting because I think over time, you're speaking to clients and they're going, but I've got plenty of equity in my property, so what's the issue? It's like there's always two parts of it. Obviously making sure from an asset point of view or security point of view, there's enough equity in a property, but obviously the more important thing is your ability to be able to repay that loan and be able to demonstrate that to the bank in all different types of economic environments as well, which we'll talk about in terms of buffers and stuff like that. So yeah, it's probably a good way to start is breaking it down in terms of what we actually look at when we go through a client serviceability exercise, and probably best to start off with income to start with, and what are the main things that we look for when it comes to income, or the types of income.
Absolutely. And that's basically when you're running serviceability, it's income, expenses, and liabilities. So if we start with the income part, which is the main part, like you said earlier, and it's funny because I had a lot of people in the past ask, I've got $2 million equity in my property, I should be able to get it out. But yeah, like you said, it's a matter of being able to service the equity you're going to release. So income also goes under different parts, I guess. So
different categories.
Categories, exactly. And you've got your PAYG income, which is basically if you're employed and work for someone. And you've got your self-employed income. So if you're a PAYG, then we use the gross annual income, which is the base income you're receiving. And that would be the main component that would be used towards serviceability. Now, obviously, there's different parts of that income. A lot of people are on different packages. They earn incomes in different ways. So that's where things get a bit more technical, like if you're earning overtime, allowances, bonuses, commissions.
Which is certainly pretty big in certain sectors out there, where it's almost like part and parcel of their total remuneration to have allowances or commissions. So
And you've got a lot of people on casual contracts, and they've been doing that for years. So there's different types of PAYG incomes, and based on every person's individual income, that allows us to know what's the borrowing capacity is, and also based on the income that indicates which lender to use based on the policy, because certain lenders treat different incomes in a different way and allow for higher lending based on how the income is received. So that plays a huge role, basically understanding what's your base annual income and where's the best place to go to maximize your borrowing. Now, if you go to self-employed income, which is people who are either sole trading or people who own a company or a trust and operate under that company. So if you're sole trader, obviously the bank want to see 1 to 2 years tax returns. Also comes back to policy and the lender we're working with. And most of the times they want to see your notice of assessment, meaning those tax returns have been lodged, but sometimes we don't need to actually have the notice of assessment. So if you're a sole trader, you need to have your individual tax returns done. If you operate under a company, then you need the company tax returns and financials done along with your individual tax returns. And the reason being is the lender want to track where that income is coming from.
It's like painting a picture as to the flow of funds and how all income gets distributed.
Absolutely. And they want to make sure that the income you are receiving from your company is healthy in a way where the company is not losing and you're making that money. Like we've seen it in cases where the company recorded a loss for the year, but the individual income is positive. So the lender most of the times would deduct that loss from the income. So these are the two main incomes, and these obviously allow us to know what sort of income we can use towards the servicing. Now, there's other different types of incomes which we use sometimes. Maybe Carlo, you can speak about those.
And I think just before I go into that, I probably just want to add one more thing with regards to self-employed income. You know, we talked about typically banks will require the last 2 years, and they'll either average it out or take the lower of the two. But I think coming out of COVID, we saw a bit of a shift from banks' lending policy with regards to accepting the most recent years tax returns as well. Pretty much because, you know, a lot of companies, their incomes were impacted, their net profits were impacted during that COVID period. So when they came out of COVID, they had the ability, you know, things ramped up back to some sense of normality. And we saw companies go back to probably where they should be in terms of a profit level. So if we took the last 2 years, you know, as we're coming out of COVID, that would actually impact them from a servicing point of view. So, you know, there are cases where banks will accept that most recent years, but you've got to have a story that sits behind that as well.
True.
And like I said, it's all about painting the picture really for what the clients are doing. So I guess other types of income that we obviously can include from a serviceability point of view, and probably the biggest one is obviously rental income.
Yes,
it's something we see with a lot of people. People have investment properties, so we need to be able to include that rental income because it all goes towards paying off the loans at the end of the day. So,
or if they're buying an investment property.
So that's the other thing is like it's well and good for those who have already got an established property, and we can obviously evidence that by rental statements and or rental agreement. But the other thing is obviously if you're looking to buy an investment property, you know, the ability to be able to actually use the proposed rental income. You know, we're pretty lucky that real estate agents are very good at putting together a letter with the estimated rental income. They'll typically put a range between X amount and X amount. The banks will typically take the lower of those two as well, and obviously needs to be backed up by evaluation of the property as well. But you know, typically when we look at rental income, whatever the gross rental income is, so this is before the agent's actually taking out their management fee, the banks will typically shade it to about 80 to 90% of that gross rental income. Reason being is obviously there may be times where your property is vacant. Something's happened to a renter hasn't paid for whatever reason. So they want to just make sure that there's a bit of a buffer there so that, you know, if something like that does happen, then we're not relying on 100% of that income all the time as well. So a couple of other different types of income that we look at as well, which can obviously be included as well. And this is probably for different types of clientele out there, but, you know, income such as share dividends, income from investments, They may have foreign income as well. So there are little type of niche type incomes that we see from time to time as well that we can obviously take into consideration. We talked about allowances. The other thing as well is we see this with a lot of the younger families as well. Family tax benefit, Part A and Part B.
Yep.
We can actually take that into consideration. If there's child maintenance payments, and we can evidence that, we can take that all into consideration as well. So the main thing is people need to be mindful of is that every bank has their own policy with regards to it. So the beauty of it is that we've got access to all those policies, and we can help guide clients through and trying to find the right lender that will accept the most amount of income, because that's what we really want to get to, is making sure that every little bit counts, and we can use that towards serviceability. So
yes, and that's the key here. Like it's not always, when we say it's not always about the rates. That's like part of what we mean. Like if you're earning a certain income and we want to maximize your borrowing, going with the cheapest offer is not the best way forward.
Yeah.
So that's where, like you said, it's really important to know where to put that deal to maximize the borrowing and get a favorable outcome. So yeah, 100%.
Yeah, exactly right. And I think that probably leads us to the next part is, when we go to do serviceability, we talk about, you mentioned earlier, the client's liabilities as well.
Yep.
And probably a good way to start off is just talking through the different types of liabilities we do need to take into consideration when we're assessing loans.
Yeah, absolutely. And the first one, obviously, is the loan that we are actually applying for. So the lender will obviously expense the loan that we're applying for, and they'll use a buffer rate or an assessment rate. Now, that assessment rate is usually 1 to 3%, depending on the lender, depending on the policy. It's 1 to 3% on top of the actual rate. So if you're getting these days a 6% interest rate, then the assessment rate will be close to 9%. And that's a very high interest rate, and that explains the limited servicing capacity that we've got at this stage, considering we've got a high interest rate, and then you've got 3% on top of that. Yeah. Like, it's killing serviceability.
But I guess if we rewind probably a couple of years ago, where rates were down at 2, people were saying then, why are we still adding on a 3% buffer? Well, fast forward to today, this is exactly why we're doing it. But so, 100%. Yeah, I guess in today's environment, 3% may sound a little bit harsh, because people are sitting there going, can they really get to 9%? But
yeah, well,
we don't know.
Exactly. And I guess being safe is a good way to do things, especially we've learnt a lot, I guess, from the 2008 global financial crisis in the US, and they did not have any of those buffers and risk assessments and all that sort of stuff. And as soon as things changed, a lot of people defaulted, and we've seen what we've seen. So yes, it is a bit too much, but also, like you said, when interest rates were lower, the 5.2 seemed a lot back then, but we've got an interest rate of 6.2 and 6.3%.
Yeah.
And that, it creates a bit of a risk buffer where, like lenders and banks and the economy as a whole is protected in a way. So if things go wrong or interest rates go even higher, the bank has done their job in terms of you actually can afford paying that loan on a much higher interest rate.
Yeah, and I think it's worthy to note that the banks will always want to make sure that you can repay the loan. The banks aren't in the business of selling up clients' houses at the end of the day. So they really want to make sure that that buffer serves its purpose correctly. Just on those buffers, you talked about that band of 1 to 3%, probably worthwhile maybe just touching on where the 1% comes into play, because typically when we're looking at serviceability, there is that usual 3%. Yep. But there are circumstances where we can just apply the 1% buffer.
Yeah, and I guess certain lenders introduced that policy for certain scenarios or certain deals where if it's a straightforward refinance, you're not taking on extra, you're within certain LVRs and even certain employments as well. They've included that 1% where it actually helps people to move from one lender to another. And also, if in certain instances where just the interest rate is actually lower, like the repayments will be equal to or less than your existing ones, then certain lenders introduce that 1% buffer where you can that would allow the loan actually to be servicing and get it over the line.
And I think they probably brought that in at the time when we talked about that mortgage cliff, where people were coming off those really super low fixed rates, going on to a variable rate, and all of a sudden they've gone from 2% right up to 6.5%. So a lot of people were really stuck with their particular lender because it was like, well, what do I do? So that's where that 1% buffer was brought into it. So,
and I guess it all comes down to the appetite of the bank or the lender to take on more business and bring in more customers without taking on too much risk. So that's why they limit it to certain scenarios and certain cases where they grow their book and they know hopefully they're going to get the customer for the long term. So that's where those buffers kick in. Also, other than the new loans that we are applying for, there's the existing loans. So if you've got an existing home loan and you're getting another investment loan, or you've got your existing personal loans or credit cards or whatever that is, also these are used in the serviceability, and most lenders also apply buffers on those. So if we can look like there's buffers everywhere, and with the income they shade it, so it's like double.
I was going to say double dipping on both sides, isn't it?
So they're super safe, but that's how things happen.
I guess if you look at the positive out of it, if you can demonstrate serviceability, you're going to be okay, because if they're shading income and they're adding buffers onto repayments, then it's just a matter of just controlling your personal expenditure, and you're going to be fine, really. Absolutely. At the end of the day. So, because
I guess if they leave it to personal decision, most of us will just maximize and take more than we can. So, and I've seen it happen. So it's just like, that's what I can afford, or that's what the bank says I can afford, then I'm just going to have to stick to it. So, I guess existing loans and then new loans. Maybe if you want to touch a bit more on like smaller loans, like credit cards, personal loans.
The ones that typically go unnoticed or people forget all about, and obviously the big one is going to be credit cards, because most people nowadays have a credit card of some sort. The trap that a lot of people do fall into when it comes to credit cards is they say, I've got a $10,000 credit card. I didn't record it because I don't owe anything on it, or I pay it off each month, so there's nothing outstanding there. Reality is that the banks want to obviously calculate it based on the limit of that credit card.
And why is that, you reckon?
Well, simply because at any point in time, people can utilise the full limit of that credit card and potentially only have to repay, 2% each month as the absolute minimum. So, it's well and good that people will say, well, I don't even use it, but it's there, it's available. The banks want to make sure that if you do start to reuse that particular card, that you're going to be okay, and we've taken that into consideration. So it's important to know that the banks will typically use a percentage of 3.8% of the actual card limit as your monthly commitment. So you do the numbers, that's a big commitment that's added into the servicing calculations on potentially a card that you may not even be using. So a lot of the conversations we do have with clients is around, if they're not using a particular card, do you really need to have it anymore? Is it worthwhile cancelling that card to help improve your serviceability?
Absolutely.
The other thing is, sorry, go.
Like this is a very important point because we see it every day, and they say, "Oh, it's owing $0," or I only owe $1,000, even though the limit is like $15,000 or $20,000 or $30,000. And like you said, it's always the limit being expensed, because you can actually access the full amount at any point.
And the other thing that caused a lot of issues in the early days was those 0% balance transfers, where people go, I'll get this credit card, I'll transfer over my balance, wipe out that one there, but they don't actually close down the old card, and all of a sudden you've got 3 or 4 credit cards with $10,000 limits, and they show up in your credit report. Exactly, and that's what the banks, and if the banks look at your credit report and they come across a credit card that hasn't been disclosed, it's not a great look, and that's important to note as well. So it's people need to be just mindful of just pretty much tell us everything in terms of what you got, and we'll have that conversation with you as to whether we think it's okay to keep that particular credit card going, or potentially look to close it. The other thing is obviously car loans. That's quite a typical one as well, whether it be a lease or just a normal personal loan. Making sure that you're disclosing that to us so that we can actually build those actual repayments into the servicing calculator. The one that gets missed, I reckon, 9 times out of 10 is the good old thing called Afterpay. Yeah. A lot of people use it, and they use it quite well. Yeah. But then they forget all about it, and a lot of those Afterpay facilities, it's very similar to a credit card, where there's a limit put in place. You may have bought a piece of furniture, and you may have actually paid down that debt. The limit is still sitting there, and once again comes up on your credit report, and the banks are coming to us and saying, "Oh, I see there's an afterpay facility the client hasn't actually disclosed. So what's the go with that?" So just be mindful. Go through absolutely everything, and note it down if need be, because something like a credit card, like a $10,000 credit card, that can actually reduce your borrowing capacity by about $50,000.
Yeah,
so
there you go.
It's massive when you look at it at all. So
there you go.
Probably the other one we see a fair bit nowadays as well, and that wonderful thing called HEX debt and HELP debt. We have a lot of people who have accumulated quite hefty debts through studying, and obviously with inflation going up as well, those balances are going up as well. So you need to actually disclose those type of HEX debts to us, because we do need to build that in, because it is essentially a repayment you need to make to the government, and it typically goes through on your payslip as in after-tax dollars. So we need to take that into consideration. So, Eddie, one of the things I think would be good to run through with our listeners as well is some actual live examples. We've talked about the different incomes, the different liabilities and expenses and all that, but just what effect it actually does have on people's borrowing capacity and their ability to service loans. And I did a couple yesterday, just at high level, and more around. I used some live examples that I'm working on at the moment. The first one was basically a young couple looking to purchase their very first home. We have the male applicant earning around $82,000 a year, female around $79,000 a year. No other debts, no other credit cards, great, but they have HEX debt for both of them around that $30,000 each. I worked through the actual scenario, and it came out with a maximum loan of about $735,000, which is not bad for a young couple looking to purchase a property. Then I thought, what happens if they actually repay that HEX debt? What impact that will have? And repaying that took the borrowing capacity up to about $800,000. So it's about an extra $65,000 in borrowing capacity, which when you look at it, the actual HEX debt is $30,000 each, so that's $60,000. So they're probably not getting ahead too much by actually repaying that. But they're the different types of life scenarios that we work through, where we can go, okay, if you were to repay it, what would the impact be? Is it worthwhile going down that pathway, or is it okay just to let it sit there and continue to pay it off?
Yes, and that's very important, having that discussion, I guess, because if you're paying out of your savings towards paying down that debt, it needs to have a significant outcome. Otherwise, you're losing that savings, especially if you're a first-time buyer. You'd be saving every bit you can.
Yeah.
You don't want to be wasting 20, 30K to borrow 30Ks extra. So
exactly.
That's where the discussion actually comes to place. Yes, that's very important.
And the other scenario I did was, a lot of people say, I want to borrow $500,000 for argument's sake. What income do I actually need in order to be able to service that type of debt?
Yes, that's very important.
So I worked through a scenario where wanting to borrow $500,000, has a small credit card of, say, $3,000 limit, so nothing too major, no HEX debt, no HELP debt or anything like that. Single person, and I worked off, say, a base salary of about $90,000, and maximum borrowings come in at about $465,000 based on today's rates. So still a bit of a shortfall, about $250 per month. Without the credit card, goes up to about $480,000 with about $150 a month shortfall. So once again, you see the impact of that credit card by removing it can increase their borrowing capacity.
Yeah.
And then I just worked through some other scenarios. Okay, how do we get it up above that $500,000 mark? And I worked on a base salary of about $110,000. That takes your borrowing capacity up to about $560 with the credit card, $575 without the credit card. So, we can work through so many different scenarios. Yeah. We're lucky we've got some great tools at our disposal where we can just punch in a whole range of different types of numbers, different types of income, different scenarios, and be able to spit out very quickly across 40 different lenders where that loan's actually going to service. So
exactly.
It definitely makes our job a little bit easier having tools at our disposal like that.
Yes. And it helps customers, I guess, know what the maximum they can borrow. It narrows down what they can look for. It helps them understand how much savings they need to have and all that sort of stuff. So it really puts things into perspective and narrows down the search on what to look for and, what to expect in terms of repayments, in terms of savings, when I can potentially get into the market. So all these questions will get answered once we run that serviceability.
Yeah.
And I guess going back into the HEX and the credit cards and the personal loans and all liabilities, I think it's actually worth getting a credit check done before actually applying for any lending. And like you said earlier, a lot of times people forget they had a credit card 5 years ago or 3
innocent
years
mistake,
ago.
correct?
Exactly, yeah. Like it happens. They've done it a few years back. They might have never used it, just activated it. They lost the card or it's expired. They threw it away, but that limit is still there showing on the credit report. So it's actually worth running a credit check. And I guess you can get like one free credit check every 6 months or so with like Equifax and those reporting agencies. So it's actually worth getting a credit check done.
Time well spent.
Yeah, and it does not affect your credit score if you get a credit check.
Yeah,
done.
that's one theory that people throw around is, if I keep doing a credit check on my my credit score, will that actually impact every time I do another credit check, where it actually doesn't? So
no, it's like they call it soft touch approach or something, where it does not actually affect the credit score, but it's important to know what to expect. And in certain cases, we actually get one done for clients when they actually tell us, I expect this or I expect that, or I'm not sure. We actually do it. But sometimes customers are like, 100%, that's all we've got. And then you put the application through and, surprises come back.
Yeah, exactly right. What are some of the other things that would affect someone's serviceability? We've talked about income, liabilities. I'm guessing expenses is probably going to be the next big thing.
Living expenses, yes. And I guess that's also a very important part of the process. I've seen a lot where so basically banks use something called HEMS, which is the benchmark they use to confirm what the expenses are based on your personal circumstances. So based on income you earn, based on your circumstances, if you're single, married, how many kids, all that changes.
Location as well, which city you live in within Australia, because that actually does change from state to state.
So all that affects the benchmark that the bank use. And I've had people who spend below the HEMS and it does not matter because the bank will still expense that benchmark. So that's also very important.
Yeah. We come across some doozies from time to time, but like you said, some people do actually declare less than that HEM level. A classic example is self-employed people. They can potentially run a lot of their personal expenses through the business.
True.
So, their actual personal expenditure is actually lower than the minimum level. So, but it's, part of our job is to obviously go through those living expenses with clients to make sure that they're realistic as well. I've had people who have claimed they can, their grocery expenses like $50 a month, and you sit back and
family
go,
of four.
if you can show me how you do that, I'd love to know, because I know mine's not $50 a month, that's for sure.
Yeah, especially not these days. But yeah, like you said, there's certain ways where we can actually explain why the expenses are lower. And also it's very important noting there's certain expenses that the banks expense outside HEMS. So you've got the benchmark, let's say a family of two with 2 kids, the benchmark is $4,500 a month. But then if you've got private school education, if you've got private health insurance, if you've got some lenders in the investment properties and body corporate fees, these are expense outside of HEMS.
Yeah.
So they expense that $4,500 a month, and then they add those expenses on top, which can affect serviceability by a big amount. So,
but reality is, the more money you earn, the typically more that you're spending as well. So,
lifestyle creep.
Exactly right. Yeah. So it's just worthwhile being open, honest about it, and because essentially there'll be banks out there who will actually go through bank statements and pick up expense items that they haven't.
Most
clients actually declared. So it's important to be realistic about it, because at the end of the day, it's your financial situation you're talking about. So.
Yes. And when you go actually through bank statements, like it's like, dude, you're definitely not spending $50 on groceries a month, like, and then the pet insurance kicks in, and then the pet food, and then vet bill, and like before you know it, you're spending 5-6 grand a month.
Yeah,
so,
hopefully not too many visits to the Crown Casino ATM
as well.
so.
And Bet 365, and
yeah, we have definitely seen them all over our lifetime.
Yeah, so before you actually do any of that, just try to reduce those expenses. No gambling, no OnlyFans. All that can affect. So and that's why we come in to actually go through this and tell you exactly what to expect and where to take that deal to make sure we don't get any bad surprises. So yeah, I think income, liabilities, and expenses, that pretty much covers serviceability. Obviously, each one of them can go into a lot more detail, but we just wanted to probably touch on each of those and try and explain it as simple as possible. And I think it was a good session.
Yeah, exactly right. And at the end of the day, anyone who's got any additional queries, best to get in touch with your broker, someone like ourselves.
Absolutely.
And we'll definitely guide people in the right direction and make sure they're across absolutely everything to get the best possible outcome, which is our job. So
that's it.
Yeah.
We'll call it a day.
Yes.
All right, cool. Thanks, everyone. And please don't forget to subscribe, leave us some recommendations or questions, and we look forward to see you soon. Bye for now.
Take care, everyone. Bye-bye.